Hello, and welcome to the next lesson where we're going to go even deeper within the model in exactly how you are going to trade your way through. Everything you see within these candles is where you're going to trade with price action. Now, price is fractal. The same candles that you see printed here look very much the same as candles that would be printed on a 3-month chart, the same that would be printed on a 1-minute chart. And your job is, if you're a day trader, is to trade in direction with what you think the daily is likely to do. And what that looks like is if you are bullish on the day, you want to be trading higher. And if you are bearish on the day, you want to be trading lower. But the idea with the way we trade, with the way I trade, is I am trying to pick the best place in a bullish environment to go higher and the best place in a bearish environment to go lower. Because we have volatile movements in the market. And when price action opens, it actually comes lower in a lot of cases before it goes higher. It will then reach a high before the end of the day when you get a retracement of some kind, giving you the total volatility in the market. And vice versa, in a bearish environment, the likelihood is that price action will travel higher first before it ends up going lower, reaching its high or low of the day before the end of that period of a trading day where price action is likely to run out of steam a little bit, creating two wicks either side, and the body of each candle is where the volatility actually happened. Now, if you are bullish overall, you are not going to do yourself any favors if you are trying to trade in this wick right here. Vice versa, if you are bearish and you're trying to sell, you are not going to do yourself any favors trading at this particular level of the wick, because that is likely going to be the end of your trading day where the volatility is coming to an end. You want to be trading in line with the volatility in an ideal situation as close to the opening price as possible. Now, I'm going to talk to you about opening prices a lot more because it's very, very important in your journey. But what we need to basically be looking for is trading in a bullish environment as low as we possibly can in the day to get the most volatility and to get most of the daily move. We then want to be trading in a bearish environment at the highest point it would like to go. So what this could potentially look like is if you're bullish, for example, price action is likely to open and actually trend lower. And you have got to guess when you think price action is likely to start reversing in the market to actually start creating this bullish wick. That will usually come when price action hits a higher time frame point of interest level. That is essentially what we look for. And it's the exact same thing for a bearish move, because price action is likely to open and actually go higher to start the day before price action decides to start coming lower, where you could then start taking advantage of some of these movements, targeting something below. And once again, price action is likely to react from some kind of point of interest area on a higher time frame. And if we can anticipate when that's likely to be, we're going to give ourselves a much better advantage in the game. And this is essentially, in a nutshell, the way I look to try and trade. And it's based around something called a high and low of the day, which you can call power of three. You can call whatever you want in reality. Now, this is all based around an algorithmic structure within price. And basically, every single candle on a day opens at a certain time, usually 6 p.m. Eastern, 11 p.m. UK time, but the algorithm will refer to New York prices. And what the algorithm actually likes to use, and I'm going to explain why this is in coming lessons, is basically midnight New York, which in turn means 5 a.m. UK time. And that is actually treated as your opening price within this particular level that we want to trade with. Again, if it doesn't make any sense at this stage, do not panic because I'm going to explain why it is the way it is. But the idea is that the algorithm treats this level as opening price. So during the times that you want to trade, this therefore means that when you're trading USD pairs, the best time for you to trade is either going to be the London session or it's going to be the New York session. And with that in mind, we would like to see London or New York session create the low of the day in a bullish environment or the high of the day in a bearish environment. Or at least the London session would be our preferred to make things a little bit easier for us. But like I said, I'm going to explain all of this in coming lessons just to make it a little bit easier. But every single day, if you can trade and you can guess the direction of a daily time frame, and you happen to be in alignment with a higher time frame point of interest area, which on this particular time frame is that area of imbalance, you can actually see if we zoom all the way in here that price action opened right here. And when price action has opened, it pushes to the upside, filling in all of this imbalance right here before breaking lower to the downside, targeting more sell side liquidity. And that is based upon you having this key level here, which is your opening price. So you can now understand, okay, the candle's going to open. The chances are price action is going to wick higher and then look to go lower. And the ideal scenario for you to be selling price action will be somewhere inside that particular area there. And if you scour through with the smaller time frames, you should be able to see, let me just make this more visible. You should be able to see potential areas in here that are likely to move. And once price action came into this area, we actually created another area of inefficient price action right here. And you can see that in itself is an entry in the markets on a 4-hour time frame. This can be enough of a model on its own because you're trading through higher time frame key level of interest, and then you're trading in direction with a smaller time frame. You can then go to a smaller time frame and you can try and gauge what you think is likely to happen. Once again, price action coming into this area, break into the downside. Maybe you're waiting another couple of days for price action to come into this area of inefficiency before targeting more liquidity lower. And again, entries and stuff like that is not going to be your concern as of now. We're going to get into all of that as we go. But the main thing to understand is that you can trade on the higher time frame, it doing the exact same thing because you had price come lower. You created a fair value gap. You could enter in there. If you really wanted to, maybe you waited for price action to come back up to here. But the key thing here is that you're above opening price. Price action travels higher during the New York session, comes lower and tags you in. This is the next day on this particular candle that price action is tagging you in, which happens to be inside a higher time frame area of interest. And this particular level opened up right here where this candle is. So price action rose higher and then drops again to the downside. So once again, within the next day's candle, you had price action traveling higher than its original area and then dropping to the downside. But we are looking to trade in direction with the higher time frame. We're looking to trade above the opening price You can see it happening there. And then we're looking to trade it in direction that we think it's going to go on the day. Now, we are not going to get this right every single time because you can see in this situation here, if you look at the daily candles, bearish day, bearish day, bearish day, bearish day, bearish day. If you got it right on these days, you were pretty much bang on the money. Let's say you caught out of 5 days where you got the bias right. Let's say you caught 3 good setups. Well, let's say you got it wrong this day, but this day here, I can tell you now, is not going to be a day high in probability because that has not got a lot of volume in it, as opposed to the next day, which had a lot more volume inside of it. So that was a higher day in probability. So let's say you lost this day. Well, that's absolutely fine because the next day, price action mitigates into whatever's inside of there and drops again. And then what happens after that is price action creates this fair value gap, which is ready for this particular candle right here for price action to refill. And you could be trading in line with the fair value gap that's been created right here, which was a much better fill. And if you're trading in line with all of this, you can then look to target more areas of inefficiency to take lower. And we've not even gone to a smaller time frame yet. But you can see that all price action is doing is respecting areas of inefficiency. So if you're guessing the overall trend, bear in mind this wick right now is happening at 2 o'clock, which is the New York AM session. Price action dumps lower, creates another fair value gap. Price action comes back in the next day during the London session, and then again in the New York session, dumps lower. You could be a part of all of that move, targeting that next liquidity. You can see here price action decides to reverse, but does give you a rejection out of it. You could have been a part of that move in the London session. And this happens at 9 a.m. this week, coming into here before this move lower. Your opening price would be 5 a.m., which is here. Price action moves higher before coming lower, taking out this level of liquidity, then pushing higher. And then when price action starts to come lower, this particular time frame inside of here, after breaking all of this market structure, price action has come back towards this particular level I can see right here. Now that is another thing we're going to talk about. It's called an inverse fair value gap, but that reaction happens in the New York session. This is a new day's worth of price action where the opening price would have begun on Tuesday, the 18th of March at 5 a.m., which is right here. Price action comes lower, pushes higher. So you want to try and look, do a little bit of backtesting and see if you can spot the wicks, see if you can try and spot the direction it's likely to go in, and you will be able to see the higher probable scenario. If you look at price action playing out as we speak, this is the opening of that particular day right there. Price action is pushing higher as we speak. This is giving me an indication that this could actually end up moving lower. And I've not even gone to a smaller time frame yet. I'm looking within these areas of inefficiency, thinking that if price action comes higher and gives me on a smaller time frame some sort of move to initiate that price action is likely to move lower, then I would like to trade it. And this is just a waiting game up until then. So that concludes this particular lesson. We're going to dive deeper into it as we go, but hopefully you got some value from this. If you have any questions, let us know. Otherwise, I will speak to you on the next one.